Hi, great to have you here again. Have you ever wondered why professional smart money traders are using price action trading strategies and not indicators? The reason is actually quite simple. Indicators are just derivatives of the price itself. So it's the price that is the most reliable indicator. It tells you what's happening with the supply and demand balance. And it is this balance that moves the prices up and down. So you have to be able to follow this without any distractions. So if you have been looking for a video that can greatly improve your hit rate and reward to risk ratio, then this is the video you have to watch. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. The best indicator is the price itself. Therefore, the best strategies are based on price action. Price action strategies are simple and intuitive, and therefore they are easy to understand. They are also highly effective, and this is why they are used by professional smart money traders. Institutional order flows dictate how the prices move. Therefore, by understanding price action, we can learn how the institutional smart money trades. Institutional supply and demand shape the markets by creating order flow that results in market structure levels being created, defended, or broken. This results in price trends and ranges that you can exploit once you understand the advanced price action trading principles. Only institutional order flow can create substantial daily time frame moves. Institutional investors are typically well informed and have access to a wealth of resources. When they are buying the market, it is often a sign that they believe the price is likely to continue to rise. This can create a self-fulfilling prophecy, as other investors may see the institutional buying as a signal to buy as well. Therefore, institutional buying that shows in price action a substantial upside momentum is a strong indication that long trades at key price levels have a high expected value, meaning that the profit expectation is high. Let's go over this once more so that you can understand what we are talking about. So first of all, the daily chart. As you can see, the market is moving to the downside with long candles. They have wide bodies, and then the market hits something here. It hits demand and starts to move sideways. And this is signified by the candles showing the loss of momentum with the body length. The market creates narrow-bodied candles with wicks. Now, for 3 days, the market is in a state of relative balance of supply and demand. And this state is about to change pretty soon. But we need to focus on what the signals are, what the indications are here that would tell us that the institutional money is moving into the market. So we have narrow range candles, we have higher lows in the market. This candle makes a higher high. This high was higher than the previous one. All of these put together give you an understanding that the market is changing the state. It's not moving downwards anymore. It's not moving sideways. It's preparing to move higher. Then we get a narrow-bodied candle, but the bears aren't able to push the market any lower because the institutional order flow is pushing the price higher. We have demand flowing in, more money flowing into this market, so we have more demand than supply. So in the daily time frame, we focus on all of this, and this gives us an understanding that the market is probably moving higher. We never know for sure, but we know the probabilities because these factors are present in all the market reversals, because the market has to create higher lows, it has to create higher highs, it has to create long-bodied up candles each time it turns higher. So this is what we focus here. And it's good to remember that market never repeats itself, but by focusing on momentum indications in the daily time frame, we can identify institutional order flow and then start to look for key price levels and long entry signals in the hourly or 15-minute charts. This is FTSE 100 chart, but these principles work in all the markets, in all the free markets. Now here we have the market pushing above this high. And in this process, it moves back a little bit. It retraces down to one of the support levels that the levels that used to be resistances. So here we have market coming down to this support level, and there is an up candle. That's the signal to go long. Then if we look at the next similar opportunity, it's up here. The market rallies beyond this point, then retraces back to it, and then rallies higher or moves higher. So this reaction higher is the point where we want to be looking for long trades in this market. This is a way to look for trades in this context. When the market is moving down, don't try to do the same, because it doesn't work. It can work maybe once or twice, but as a rule, it doesn't work. So we want to keep the probabilities on our side. We want to trade the long side only when we know that the institutional money is flowing into the market. Let's take a look at another example. This time I'm going to use a daily time frame chart in combination with an hourly chart. In this example, we can see how the daily time frame chart starts to move sideways after a move down, and then we have higher lows. The market moves sideways a little longer, but then we can see a higher low here and a strong candle to the upside. And we see another higher low and a strong candle to the upside. That leads to a strong momentum move on this day. And this is where we can move to the hourly chart. As you can see, the market doesn't always create similar settings where the market goes through a resistance level and then retraces right back to it. When there is lots of momentum in the market, the institutional money comes in to the market earlier. So you might see the market turning higher from practically nothing. There is no support level for the market to focus on, but it still starts to move higher. So we need to have a way of engaging the market also in these situations. So what we do in these, what I like to do in these situations is that I wait for the market to retrace and then look for momentum reversals, because that is a signal that now institutional demand is somewhere close by. It's pushed the price higher. So the probability of the market moving higher from here is great. It doesn't do it straight away. It comes back to the same area again. But once we see the momentum reversing to the upside again, we have further evidence that the market is likely to move higher. And then that's a good opportunity to engage in the market on the long side. Again, this is something that shouldn't be tried when the market is moving to the downside. This is a strategy for the context where the market is moving higher in the higher time frame. And now we have a similar setup, but now reversed. And the wide-bodied candles were replaced by narrow-bodied candles, and we have wicks in two different directions here. But that's not important. The most important is that the momentum changes. We have the momentum loss here, and then the market reverses. We look for a clear close below this market top, and then we can go to the 15-minute time frame chart, which here shows how the market creates lower lows and then creates a double top there, breaks a key support level, and now this support level becomes a major resistance level for us. So if the market returns back to this level and then starts to move lower, we know that the institutional order flow is pushing the market lower. Therefore, this is a much safer place to look for a short entry than here, where the profit margin might have been better, but it's not as clear whether the market is going to actually move to the downside or just consolidate and then move higher again. It's better to wait for the market to reverse and then look for a short trade. I hope you found the video helpful, and as usual, if you have any further questions on price action and trading, please feel free to email us on support@theomarkets.com, or you can leave your comments and questions below in the comments section. So thank you once again for watching, and see you soon.